In 2009, the Nigerian banking industry was shaken by a massive fraud case involving Oceanic Bank International Plc, one of the country's leading financial institutions. The case centered around Cecilia Ibru, the former managing director of the bank, who was found guilty of fraudulently obtaining over 160 billion naira from the bank. This incident revealed significant corporate governance failures within the Nigerian banking industry. Oceanic Bank was established on March 26, 1990, as a private limited liability company and obtained its license on April 10, 1990. It started its operations on June 12, 1990, at the Waterfront Plaza, Plot 270, Ozumba Mbadiwe Avenue, Victoria Island, Lagos, and became listed on the Nigerian Stock Exchange on June 25, 2004. Cecilia Ibru joined Oceanic Bank as a general manager in 1990 and after 7 years became the managing director and CEO. Under her leadership, the bank experienced rapid growth, expanding its branch network and increasing its assets to over $4 billion in 2008. Ibru was hailed as a visionary leader who transformed the struggling institution into a prominent player in the Nigerian banking industry. The fraud at Oceanic Bank came to light in 2009 when the Central Bank of Nigeria, CBN, examined the bank's records and uncovered inaccuracies in its financial statements and significant discrepancies in its books. A subsequent special audit revealed that Cecilia Ibru had embezzled over 160 billion naira from the bank. The audit report detailed various schemes employed by Ibru and her associates, including the creation of fictitious companies, diversion of depositors' funds, and inflation of contract sums. It was discovered that Ibru had utilized the embezzled money to acquire multiple properties both in Nigeria and abroad, such as a mansion in London and a hotel in Dubai. The revelation of this fraud stunned the Nigerian banking industry and raised concerns about the competence of the bank's board of directors and the effectiveness of the regulatory framework. As a result, the CBN dismissed the bank's board of directors and appointed an interim management team. Cecilia Ibru was removed from her position as the managing director, arrested, and charged in court. In 2010, she pleaded guilty to 3 counts of financial fraud and received a sentence of 18 months in prison. Additionally, she was ordered to forfeit assets worth over $1.2 billion, but her sentence was later reduced to 6 months due to her cooperation with authorities. The conviction of Ibru sent a strong message to other bank executives that embezzlement and financial malfeasance would not be tolerated in the Nigerian banking industry. However, the fraud at Oceanic Bank was not just a case of embezzlement. It also exposed significant corporate governance failures. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It establishes the framework of rules and procedures governing the relationship between the board of directors, management, shareholders, and other stakeholders. In the case of Oceanic Bank, the failure of corporate governance was evident in several aspects. Firstly, the bank's board of directors failed in its oversight function by not detecting the ongoing fraud for several years. Secondly, the bank's internal control systems were weak and ineffective, allowing the fraud to go undetected. Additionally, the bank's internal audit department, which should have ensured compliance with internal policies and procedures, was compromised and colluded with the fraudsters. Lastly, the regulatory framework was inadequate in preventing such fraud, as the CBN failed to detect the wrongdoing until the special audit uncovered it. This regulatory failure highlighted the need for a more robust regulatory framework to prevent similar frauds in the future. The fraud at Oceanic Bank served as a wake-up call for the Nigerian banking industry, emphasizing the importance of stronger corporate governance practices, more effective internal control systems, and a proactive regulatory oversight. From the Oceanic Bank fraud, several lessons were learned. The significance of board oversight. Boards of directors should consist of independent members with the necessary skills and experience to oversee the company's operations and ensure compliance with regulatory requirements. The necessity of strong internal controls. Companies should establish robust internal control systems to ensure operational efficiency, safeguard assets, and maintain accurate financial statements. Internal auditors should be independent and report directly to the board of directors. The importance of regulatory oversight. Regulators should adopt a proactive approach to oversee the banking industry, conducting regular audits and examinations of banks' operations. Regulators should also have the authority to take corrective action when necessary. The requirement for ethical leadership. Companies should foster a culture of ethical behavior and promote a strong ethical tone at the top. Leaders should lead by example and ensure that employees understand and adhere to ethical principles.